let's go on with Claudio Borio.
Thank you. Well, thank you. Thank you very much. I would like to thank the organizers for the very kind invitation. I'm delighted and honored to be here. Now, the topic of this session is how to reconcile sovereignty with effective supervision. And this is just a small piece of a much bigger question, which is how to reconcile sovereignty with effective policymaking generally. Now, in my presentation, I will take a small piece of that small piece, and it is just to illustrate how one element in the new regulatory framework put in place in Basel III, is dealing precisely with that issue. And I'll be talking about the countercyclical capital buffer. But before I go on, let me just make two general remarks. First of all, particularly given the number of journalists in the audience, I'd like to stress that the views that I'll be expressing are my own and not necessarily those of the BIS. And secondly, for the sake of transparency, let me lay down the cards on the table. And I think there are two contrasting views of sovereignty. One sees sovereignty as unitary and absolute, and it harks back to the 17th century, and it's been taken up by the Realist School in international relations. As Robert Cohen says, sovereignty, according to this view, is like pregnancy, and you cannot be half pregnant. There is, however, a much more nuanced and pragmatic view of sovereignty, which sees degrees of sovereignty depending on the domain in which decisions are taken. And I'm very much in this second camp. I believe that in a globally integrated world, absolute sovereignty is neither feasible nor desirable. It's not feasible because decisions taken in the rest of the world can really easily undo whatever sovereign states decide. And it's not desirable because the end game would be absolute sovereignty would be autarky and permanent conflict. And I think that for lasting prosperity, there is no alternative to the sometimes tiring and I would say frustrating give and take of close international cooperation. Now, let me illustrate all this with the countercyclical capital buffer. And let me say that the countercyclical capital buffer is a very new element in Basel III, and it's designed to deal with the pro-cyclicality of the financial system. And it's one of the two so-called macroprudential overlays, the calibration of instruments with respect to systemic risk in the framework, the other one being the capital surcharge for systemically important financial banks, financial institutions. Now, an underappreciated point about the countercyclical capital buffer is that it requires very close international cooperation in order to make it operational. And it does imply a shift in balance in decision-making power from the home to the host supervisory authority, but a shift in power which is fully intended in order to make the mechanism effective. So in the structure of my presentation, I will first of all talk about the rationale and basic features of the countercyclical capital buffer, and then I will move on to address how the scheme deals with the international cooperation issues, which is very much where sovereignty comes in. But before I do so, I think we need to step back and say, what is the problem that the countercyclical capital buffer is designed to address? And that is that the serious financial crises tend to coincide with the bust phase of the financial cycle. And by financial cycle, I mean the self-reinforcing interaction between perceptions of value, external financing constraints, and risk appetite that tends to amplify financial developments, and through that, amplify also the business cycle. And the word these days for this phenomenon, which has become quite popular, is pro-cyclicality, dealing with the pro-cyclicality of the financial system. The basic idea is that during booms, balance sheets can become overstretched so that financial imbalances build up, sowing the seeds of the subsequent bust. So that, according to this view, financial crises are seen as fundamentally endogenous events. They're not like the meteorite strike from outer space, but the booms do not just precede, but cause the subsequent bust. And this, of course, goes back to a very old literature in macroeconomics that predates the Second World War, and also to the writings of people like Kindleberger and Minsky, and we heard that in the previous presentations. Now, if this is the problem, then what is the basic policy principle? And I think that the policy principle is to put in place countercyclical prudential buffers. The idea is to build them up in good times, when it is cheaper and easier to do so as to be able to run them down in bad times, which would protect the financial system from the unwinding of financial imbalances and would act as a kind of stabilizer, because during the bust phase, it would limit the incentives to have a credit crunch and fire sales. And during the build-up, to the extent that it makes risk-taking more costly, it might actually help constrain the build-up of the imbalances. Now, all this is well and good, but in theory, but how do you put it in practice? And here, for example, a key question is whether there are simple indicators of the financial cycle that can guide both the build-up and the release of the buffer. Now, there are many tools that can be used for this purpose, including LTV, loan-to-value ratios, provisionings, and the like. But Basel III concentrates on one tool, which is capital. Hence, the need to put in place countercyclical capital buffers. Now, what would the ideal indicator look like? Well, for the build-up phase, you would like to have the best leading indicator of systemic financial distress, with a lead that varies between, say, 2 to 4 years ahead, so that you have enough time to build up the buffer gradually. For the release phase, on the other hand, you would like to have the best contemporaneous indicator of financial distress, because that's precisely the time when you need to use the buffers. Now, this gives rise to a kind of engineering problem, because it's very hard to imagine how a single variable, or indeed a single set of variables, can both act as the best leading and contemporaneous indicator of financial distress at the same time. So the response that the scheme has to this is to distinguish very clearly the variables that will help you with the build-up and those that will help you with the release phase of the buffer. Now, like philosophically, the basic structure of the buffer tries to exploit what I would call the paradox of financial instability. And that is that the financial system looks strongest precisely when it is most fragile, so that systemic risk is highest. And that's precisely the time when short-term volatilities, risk premia, loan losses are unusually low, credit growth and asset prices and profits unusually high, so that leverage measured at market prices is artificially contained. That is precisely the time when risk is building up in the financial system, so that what really looks like low risk is in fact a sign of high risk-taking, so that stability betrays underlying instability in the system. Now, in other words, raw market prices, as well as income and balance sheet data, behave more like contemporaneous indicators of financial distress than true leading indicators of financial distress. So here the basic idea is that for the build-up phase, one should use some of these variables suitably normalized, and use them as contrarian indicators of risk. And for the bust phase, you can actually rely on some of these variables and as they are, raw data, in order to release the buffer. Now, I have a number of graphs in the slides, but I will not be able to go through them. But basically, they try to substantiate each of the points that I will be making in the presentation. So, what variables has the Basel Committee decided to use for the countercyclical capital buffer? Well, as far as the build-up phase, there is quite a literature, and indeed a literature to which the BIS, among others, has contributed, that suggests that the most promising, simple, real-time leading indicators of financial distress are based on the joint, and here where joint is important, joint positive deviations from historical norms, what one might call gaps, of the credit to GDP ratio, which is a rough estimate proxy for leverage, and asset prices, particularly real estate prices, as a very, very simple proxy for overvaluation. And if you take these two variables together, they provide the best signals of financial distress with a lead of between 2 to 4 years ahead, and also, importantly, out of sample. And indeed, there is a graph in the presentation that shows how this was the case for the United States ahead of the current crisis. But of course, Basel III has to make things even simpler, because also you have to have something which is comparable across countries. So it narrows down to the best single indicator for the build-up phase, which is the credit to GDP ratio. And so the deviations of the credit to GDP ratio from a historical norm, normalized in a particular way, are used as a common reference point across all countries from which to start exercising judgment. So you have essentially the same formula for all the countries, but countries are allowed to deviate from this as long as they explain why they're deviating from it. So a kind of comply or explain principle. Now, for the release phase, on the other hand, it has really proved very hard to find common indicators of financial distress, contemporaneous indicators of financial distress, that could work effectively across countries so as to have a single formula. So here there is a greater degree of discretion based on variables such as accounting losses, a tightening of credit terms, or an increase in risk spreads, and this will vary from country to country. But again, the authorities need to explain what they're doing and why they're doing so. Now we come to the cross-border problem. So how is this dealt with? There are basically two issues here. One is what one might call the indicator problem, and that's the fact that what happens if the losses in a particular banking system are not incurred within the particular jurisdiction, but are incurred outside in some other country. So, and this is typical for example, multinational banks. So, for example, and again, some graphs in the paper will show that in the case of the United States and the UK, these type of indicators would work wonderfully. But of course, they would have missed completely the problems that German banks and Swiss banks had because they were exposed to the United States. There is then the control problem, and that is how can a national authority offset the impact of international lending on its own economy? International lending that can occur either directly through lending offshore or through the branches that may be present in the country over which typically the host supervisory authority has less leverage, has less power to act. So this also means that it could risk putting its own banks at a competitive disadvantage vis-à-vis the foreign banks. There is also an issue, which I think was implicit in what Andy Haldane was mentioning earlier, which is the well-known size asymmetry problem. The fact that home supervisory authorities may lack the incentive to impose higher capital requirements because typically, although these exposures may be large for the recipient countries, for the host countries, they can be quite small in relation to the very large balance sheet of some of the multinational banks. And this is basically showing how these things actually work in practice. So how does the countercyclical capital buffer address these problems? Well, to deal with the indicator problem, the idea is to base the countercyclical buffer on a weighted average of the exposures of individual banks to the various jurisdictions. And for example, if you had done this in the case of the Germany or Switzerland, you would have been able to see that banks were building up serious risks in another jurisdiction. What about the control problem? Well, in this case, what the countercyclical capital buffer does is to put in place cooperative arrangements, reciprocity arrangements between the host and the home country. It is the host country that has the responsibility to activate the buffer whenever it sees signs of the buildup of risks in its own jurisdiction. And the home authority can actually require more from its banks if it wants to be particularly conservative, but it cannot require less, which is really dealing with this level playing field issue that I mentioned earlier. Now, this does imply that there is a very conscious and intentional shift towards greater responsibility given to the host authorities, which is absolutely critical for this mechanism to work effectively. In addition, there is a supervisory group which is in charge of monitoring that the scheme is effectively operated across jurisdictions. So let me conclude. I think that the countercyclical capital buffer provides a concrete example of how to reconcile sovereignty with effective supervision. It goes beyond the illusion of sovereignty in a globalized world. It addresses the issues head-on. It devolves authority to the host countries, which are those that stand most to lose from the domestic financial cycle. and it contains effective cooperation mechanisms. Now, one may wonder here whether this could not be a model for cooperation on macroeconomic issues more generally. Because I think that, as the late Padua Schioppa said, I think we need to go beyond the illusion of the own house in order doctrine. The idea that if each country does things right, also the situation for the world as a whole is going to be the right one. I think that this calls for a conceptual shift which is analogous to the one that has already taken place in regulation and supervision, from a microprudential to a macroprudential perspective. A microprudential perspective being the idea that if you focus on each individual institution, the whole system is going to be sound. The macroprudential perspective, one that actually looks at the financial system as a whole, taking into account the correlations of exposures across firms, taking a top-down approach, and taking into account, importantly, that the risk which is generated within the system results from the collective behavior of institutions, so that it's really endogenous and it's not exogenous with respect to that. So that just as no individual financial institution can be safe unless the financial system as a whole is, so no individual country can be safe unless the global economy is also safe. Of course, how to implement such an analytical and political and policy shift is another story that goes well beyond my presentation. Thank you very much.
Thank you, Claudio, for staying just 1 minute beyond your time constraint and presenting a wonderful paper.